Welcome to The Explainer. Today, we're going to talk about a super simple 9-point checklist for stocks. Think of it as a tool that helps you tell the difference between a real bargain and a total financial time bomb.
All right, let's be honest. Have you ever bought a stock that looked cheap, only to watch it just keep getting cheaper? It's so frustrating, right? That feeling is one of the most common traps in all of investing.
Well, there's actually a name for this problem. It's called a value trap. See, the stock is cheap for a very good reason. The company itself is falling apart. So the real question is, how do you spot these warning signs before you get caught?
So how do you separate the real winners from the losers? Well, what if I told you we need a reliable system? And lucky for us, a brilliant accounting professor might have created the perfect one. Yep, the solution comes from a guy named Joseph Piotroski, an accounting professor from Stanford. Back in the year 2000, he published this amazing paper with a really simple but incredibly powerful framework. And its whole purpose was to find these hidden gems, these healthy companies that just look like cheap stocks. And he did it with a checklist, using just 9 simple financial tests. It works like this. For every test a company passes, it gets 1 point. The total score, out of 9, is what we now call the Piotroski F-score. Simple, right? Now, these 9 points are brilliantly organized into 3 key areas. First, you've got 4 points for profitability. Is the company even making money? Then 3 points for financial health. Is its balance sheet getting stronger? And finally, 2 points for operating efficiency. Is the company actually getting better at what it does day to day? Okay, so this whole 9-point health check, it's really built on those 3 pillars of strength. Let's dive into the first one, and you could argue it's the most important one. Profitability. So for profitability, there are 4 simple checks. First, is the company making a profit? Positive net income. Second, is it generating positive cash from its operations? We also want to see if its return on assets is getting better. But here's the kicker, the really crucial test. Is the company's operating cash flow higher than its net income? If it is, that's a fantastic sign of high-quality earnings, not just some accounting magic. Okay, next up, we've got financial health. Here, we're asking, is the company paying down its long-term debt? Is its current ratio improving? Basically, does it have more cash and easy-to-sell stuff than short-term bills? And a big one, has it issued new shares? Because, a company that isn't desperately printing new shares to raise cash is usually a much healthier business. And the last piece of the puzzle is operating efficiency. Just 2 quick checks here. First, is the gross margin getting better? That shows it has more power to set its prices. And second, is its asset turnover improving? This just tells us if the company is squeezing more sales out of every dollar of assets it owns. In other words, is it running a tighter ship? Okay, theory is great, but how does the score actually perform in the real world? Let's put it to the test. We're going to look at 2 very different examples from the Indian market to see it in action. First step, let's take a look at a company you probably know, Hindustan Unilever, or HUL. It's a massive consumer goods company. When it was analyzed, it got an incredible F-score 8 out of 9. That's almost perfect. So what did that 8 mean? Well, Hull passed almost every single test. We're talking strong profits, amazing cash flow that was even better than its reported income, and its efficiency was improving. The only little thing it missed was a small dip in its current ratio. But overall, the score tells you everything you need to know. This is a fundamentally healthy, strong business. All right, now let's flip the coin and look at the total opposite. This is a historical example, a textbook case of a value trap. We're talking about Reliance Communications, or RCOM. Before it collapsed, it had an F-score of just 2 out of 9, a total disaster. Just look at this report card. It's just failure after failure. Profits were negative, it was burning through cash, debt was piling up, margins were getting crushed. The F-score was basically a giant screaming alarm bell, flagging every single sign of major financial distress. It was sending a crystal clear signal. This is not a bargain. This is a business in deep, deep trouble. Okay, so we have these scores, right? An 8 for a great company, a 2 for a terrible one. But what do you actually do with that number? How does it translate into an actual investment decision? Well, the beauty of this system is that the interpretation is incredibly simple. If you see a score of 8 or 9, that's a sign of an excellent, top-quality company, a really strong candidate to look into. But if you see a score from 0 to 3, that's a huge red flag. That's your potential value trap. And anything in the middle, well, that just means you've got more homework to do. And you know what? The results really do speak for themselves. A study looking at the Indian market over a decade, from 2015 to 2024, found something amazing. A portfolio of high F-score stocks returned almost 19% a year, and the low F-score stocks, they returned less than 7%. That is a massive difference in performance, all separated by this one simple score.
But of course, we have to be realistic. No tool is a magic bullet, right? The F-score isn't perfect. It can have a tough time with certain industries, like cyclical ones such as metals, or with those super high growth companies that are burning cash on purpose to grow really fast. So you gotta remember, this is a powerful filter, not a crystal ball. It should be the starting point of your research, never the end.
So the big question is, how can you start using the F-score? Well, here's a really straightforward 4-step process to get you started.
Okay, it's a simple 4-step process. First, you gather the financial data from the last 2 years. Pretty easy to find. Second, you just go through the 9-point checklist and calculate the score for each company. Third, you screen your list of potential stocks. Maybe you filter for anything that scores a 6 or higher. And finally, number 4, you make this part of your routine. Use the score to check on your existing stocks every quarter to see if anything's changed.
You know, the real genius of the F-score isn't just the checklist itself. It's the system. By turning something subjective, like quality, into a hard number, it forces you to be disciplined. It helps you fight that gut feeling, that emotional urge to buy a stock just because it seems cheap. And that's the impulse that gets so many investors into trouble.
So I'll leave you with this final thought. Ask yourself, is your portfolio missing a quality filter? Do you have a system, an unemotional, repeatable way to check the basic financial health of your investments? Because that's exactly what the F-score gives you. A simple, proven, and really powerful way to do just that.